Okay, welcome back to part three as we continue on trying to get through C corporations as business entities. In class, we did net capital losses, we did net capital gain losses, and so these particular slides that we're looking at now are things that you should concentrate on in your reading. Make sure you know how to do the carrybacks. Make sure you know that there is an election not to carry back if you wish. So it's easy mathematics, but nevertheless, make sure you know how to do it. David Cantor had asked in class about, or somebody had asked in class about how do you do a carryback if you have to do an amended return. So here's the form. If you do it within 1 year, you can just use a form 1139 on the carrybacks to get your tax refunds right away. Let's talk about charitable contributions when it comes to a C corporation. The first thing to recognize is that the tax law takes a dim view to recognizing charitable contributions from a corporation, because the big question is, can a corporation as a individual entity, can a corporation be gratuitous? That means, can a corporation actually make gifts to somebody? Corporation doesn't have a heart, doesn't have a soul like you do. You have a heart and a soul that says, yeah, I want to make a gift to somebody. Corporations don't do anything other than for its own profit, according to one theory of taxation. So therefore, the amount that is deductible from in a C corporation for gifts or charitable contributions is going to be strictly limited, and that's what we want to learn about now, what those limitations are. First of all, the amount of the deduction is based on the fair market value of property given. If it's capital gain property, they can take the deduction for the fair market value. They can take the deduction of ordinary income property at the adjusted tax basis. So there's no incentive really to give that away, whereas here, up in the capital gain property, this is a good idea, because if you get the deduction of the gift at fair market value and you don't have to recognize the gain, just like an individual doesn't have to recognize the gain when they give away capital gain property, this is somewhat of a win-win situation. So that's a good deal to do. But if you give away inventory, you can't take a deduction for more than your cost. That's what this is saying. All right, when you deduct it, that's under the accrual method, if you're an accrual method corporation. Here's the key, though, of that what I said before, that corporations are not considered by tax law to be really gratuitous, or they don't have at least a strong enough soul to think that they're like us, that they can be giving away lots of money. But they do get some deduction. What they get is a deduction limited to 10% of their taxable income before deducting certain items, which are listed here. And of course, before deducting the charitable contribution makes sense. Dividends received deduction, which we did learn about. We'll go over that again in a second. And operating loss carrybacks. The domestic productions activity deduction, which we learned about earlier in the semester, and capital loss carrybacks. So you make these adjustments to figure out your taxable income, where your limit is 10% of the taxable income before deducting these items. That's basically what you're doing. And so what I would do is, if I am, of course the computers do this automatically, but if I'm trying to figure out how much charitable contribution a corporation will take, I'll go to its taxable income and adjust it for the items here, adding them back. If you can't get all of the charitable deduction you made in a particular year as a C corporation, you can carry it forward. No carryback, but you can carry it forward for 5 years. And if you can use it up in those 5 years, great. If you don't, you lose it. All because corporations are not considered to be really able to be as gratuitous as a human being was, so that's why it's a 10% limitation. All right. Let's see an example. 2014 PCC, a C corporation, donated $700,000 in cash to the American Red Cross, its taxable income before the charitable contribution deduction. NOL, and all the other things on the other slide that says that you have to add back to the taxable income or figure out your taxable income before deducting these items. And so the question will be, what is PCC's charitable contribution deduction for the year, and what is its carryover, if any? So let's see how it works out. Let's see if I can do it. What is its taxable income? Taxable income before the charitable contribution was so they tell you was this number. The taxable income before all these items was 6.287. So 6.287, 6 million. Take 10% of that, and we should get 628,700. That's what it should be. So the limitation, since they gave 700 away, would be the difference. Let's see if I'm even close to this. Let's see what happens. Well, they do it. All right, so there's a slight difference. Oh, because you get to they take the 10% is 70,000. What did I do wrong? Don't tell me. See, start with the taxable income. That they did that. Subtract that, they get 6.2. Why did they do that? I didn't read the problem, as you noticed. Before the charitable contribution deduction and okay. Oh, okay. So let's go back to the rule. You notice the NOL carrybacks are what is an add back to the taxable income. So here they said they fooled you. They fooled me anyway. This is an NOL carryover. So this, if the net taxable income was 6.287 before these items were deducted, the NOL carryover can be deducted because it's only the carryback. If you see there, it's only the carryback that can't be. So here you get to let's see, you get to take that off as a deduction. Or you have to take it off as a deduction, so this becomes the limit, and 10% of that is 300. So clearly we could see that there was going to be some amount not allowed as a deduction in the year and it's carried over. All right, let's talk about the dividends received deduction very quickly. By the way, make sure you know how to do the basic calculation that you see here, based on the rules listed here. It's a good thing to be aware of from your textbook reading. All right, dividends received deduction. What happens here is the concept of the following. We talked about this perhaps a little bit, is we know that C corporations are subject to a double tax. Here's the theory. Double tax. How so? C corporation makes income, pays a tax. C corporation pays a dividend, which they're expected to do because their shareholders expect it. Pays a dividend. Shareholder is taxed. So this is one tax. That's tax number 2, double taxation. What if the shareholder was itself a C corporation? What happens then? And the C corp, in this case, would pay tax on that dividend. Tax number 2. But then that C corp goes and pays dividend from those earnings. It goes, pays a dividend, and it pays it to its shareholders. And they pay tax. Because that's what C corporations do. They pay dividends. That's tax number 3. What if this corporation over here, this shareholder is a corporation? What if it is? It doesn't have to be, but what if it is? And then they pay a dividend, and you can see it just goes, it could go on and on. Tax number 4, tax number 5, and it could just go on and on. Ad infinitum, ad nauseum. Ugh. So I'll say ugh. So the dividends received deduction, the theory of it is to mitigate more than 2 levels of tax. Depending on the ownership of your stock, you get to reduce as taxable income a certain percentage of the dividends received. That's why it's called dividends received. C corporation receiving dividends, if they're received from another C corporation and they own less than 20%, 70% of the dividend is non-taxed. If they own 20 to 80 but less than 80, 80% of the dividend received is not taxed. And if they own 80% or more, all of the dividends received from another C corporation by a C corporation is not taxed. So these limits are the amounts not taxed on dividends received, so that the double taxation doesn't become ad nauseum over and over again, triple, 4, 5 times, 6 times, etc., etc. And there's some limitations to it, but this is the basic theory, and that's what I'm interested in you knowing. Okay, I think that let's see, this is the limitation, is the percentage that we just learned about. And then there's a possible modified dividend taxable income. So pay attention to that in case a question comes up on that. So I'm not saying I won't ask a question on it. I'm just saying, and I might. So pay attention to these limitations. These are the type of limitations here in this paragraph here that I'd have to look up myself. I don't commit these to memory, so I would just understand what you need to do, that it exists, that it's another limitation on the dividends received deduction. Okay, here's an example. Go through these examples and make sure you know how to compute them. Probably give you some homework assignment on it somewhere along the line, and we'll do that together in class. And we'll stop here and pick up from here next time.